we have quite a bit to cover on today's show, but I think we should start by getting people anchored in the long-term real estate success formula. Now, funny enough, we do this a lot because when we speak to the real estate investment network community, hundreds of thousands of investors across the country, we always come back to this. We do this in live events, we do this in Zoom events, virtual events, but we thought it'd be important to kind of get grounded in rein it in as well, because this really demonstrates the lag in the economy. And we open this segment by talking about, is the Bank of Canada winning? And to answer that, you really have to look at the lag and you have to see what's coming down the pipeline in terms of lag. So let's cover this long-term real estate success formula and then dive into the rest of the show.
It's interesting about this success formula, JG. We have been grounding investors in this success formula for over 20 years. I'm seeing this chart used more and more by others because at the end of the day, we have to get back to data. We have to get back to logic. We need to take the emotion out of investing in real estate, which is really difficult to do given the headlines, given the kind of doom and gloomers. There's a bubble, there's no bubble. We have to say, okay, step back from the divisiveness, the polarity, all of the things that are happening at a macroeconomic level and say, okay, what's really happening in our economy and how do I make decisions based on what's happening? Now, the long-term real estate success formula, as you can see here, we always go back to the bottom left-hand side of that, which is to say, what are the economic fundamentals that drive an economy? First and foremost is GDP growth, the economic health of any country, any region, any city. We need to know what that is, because when GDP is positive, we know that we've got employment growth. People are working, they're being productive, they've got jobs and they're getting paychecks. And when we see GDP in any region pick up, we see the job growth pick up, and we see people move into a region. Now, we're seeing that in spades right across the country in terms of what's happening with people in interprovincial migration, where they're moving to, what they're doing. And the reason that is, we're seeing population growth in certain areas because of job growth. And when we see that, we see increased rental demand. We do, in fact, see vacancies come down, which in some provinces, some cities are at historic lows. And then we start to see rents increase. Ultimately, property prices increase because of the supply-demand issue that continues to happen. And then we see prices go up. So this particular success formula, JG, when you look at the economic fundamentals, doesn't change. It is static and it takes the emotion out of it. And if you're just looking at data, this is a way for you to start to make decisions. And we look at the lag time that we talked about earlier, which is in that 18 months, 2 years, we start to see these things happen.
Now, this formula works on the way up. As we talked about, if you have growing GDP, growing employment, growing population, then the rest happens. Those are the driving forces. Same goes with the decreasing. If you have decreasing GDP, decreasing employment, therefore growing unemployment, then you're going to have some population decline. And as a result, the rest flows down. What's interesting though, Patrick, and this is the most important point to this entire formula, is you cannot look at this formula as a country when it comes to real estate. You can't even look at it provincially. You have to look at a region, because I'll give you a perfect example. Let's just say Ontario is going through some lower GDP and some growing unemployment and some population decline. Maybe not. We'll see. We'll look at the actual numbers today. That doesn't mean every region of Ontario is going through that. Doesn't mean Peterborough is going through that. Doesn't mean Newmarket's going through that. Doesn't mean Niagara Falls is going through that. So you have to look at this data regionally. And Patrick, we've been shouting this from the rooftops for 30 years, that real estate is regional. And the question becomes is, what do you track? These are the things that you track. And this is really what we base everything on at the Real Estate Investment Network and in this show, to tell you where real estate is going. It's not a guessing game. It's not a speculation game, Patrick. It's really, we're not just like,
I wonder where the real estate winds are pointing today.
I mean, we have data to show people where it's going, which is why you're often so right when it comes to real estate, yet so wrong when it comes to oil. But more on that in later in the show.
Listen, it's always a timing issue, and I'm so often so far ahead. I joke, but here's the thing about all of this, JG, is we look at the economic fundamentals and then we look at influencers. And so right now we look at what's happening in the real estate market. It's slowed down. There's not enough listings coming on. People aren't able to buy and afford, and a lot of that is driven by one of the big influencers right now that's in our face. There's two, but one of them is interest rates. The other is immigration. So when we start to see these influencers, they're shorter term. The key with real estate, and you kind of alluded to it in just what you said in a moment ago, it isn't a daily thing. We have to look at real estate. It's not like the stock market that's going up day by day or down day by day. It really is a looking into the future, starting to anticipate what will actually unfold. We know that interest rates right now, we went through this big high. Now we're starting to get leveled off. And already, by the way, and we'll talk about it in a minute, but already we're starting to see the impact of interest rates stabilizing and even the anticipation of them going down and what it's starting to do again in the real estate market. Now, having said all that, there's always lag. It isn't day to day. And that's why we look at these economic fundamentals. We consider the influencers, and then we can make decisions from there.
All right, Patrick. So I think we should dive into some of this data, because when we look at this, back to our long-term real estate success formula, it's really making data-driven decisions. Well, if you're going to make good data-driven decisions, you need access to good data, and you need to track this data, which is why so many people listening to this are part of the Real Estate Investment Network. That's what we do at the Real Estate Investment Network. So let's get into some of the data here that is showing kind of where real estate's going. Now, caution to everybody. Most of this data is provincial or national at best. You have to go find this data for the region you invest in. And that's where you can use tools like the DI Vault, right? Patrick, di-vault.com. The DI Vault tracks this region by region, along with a host of other data, and artificially intelligent machines crunch this data for investors. But I digress. This here chart that you're seeing on the screen now is all about the unemployment rate, Patrick.
Yeah, so this is a national unemployment rate, and we don't look so much at national. It's a benchmark, right? So when we look at the national unemployment rate, we see it tick up to 5.8%. In the opening, we talked about is Bank of Canada getting its way? Well, Bank of Canada, in order to bring inflation down, had to slow the economy down. The economy is running too hot. So if we start to look at the impact of raising interest rates, right, then we see the lag. And so when you look at unemployment early on, and this goes back to January 2023, but if you actually went into 2022, you'd start to see that unemployment was at that 5%, 4.9%. It was very, very low. And that's an unhealthy low, by the way. To your other point earlier, is all of a sudden now you can get labor. Back then you couldn't get labor because everybody was working, and or at least those who wanted to work. The point is this: that lag of the increase in interest rates is starting to pick up. Now, we've talked about this. I've shone a light on it on more than one occasion, JG. And here's the thing about it. As interest rates go through the system and the impact of it, businesses start to slow down a little bit because of the cost of doing business, and they start to slow things down a little bit. We start to see consumers don't have as much money, not as much disposable income, so they start to spend less. So the ripple effect of that is what? Is that businesses slow down and we start to see the uptick in unemployment. We know that's happening in the construction industry and the housing industry. And so no surprise, 5.8%. I think that number is going to go higher. For example, in Ontario, I think you're going to probably crest 6% sometime probably in this first half of 2024. That's my guess, by the way, just my opinion. And you'll start to see other provinces where it's not so much. But this is what's happening, back to what you said.
Is that a Patrick prediction? Can we put that on the board as a Patrick prediction?
Put it down. Southern Ontario, unemployment's going to break 6% in first half of 2024.
Now, I want to give people a sense here, folks, of where unemployment was, because I really don't like these short-term charts, Patrick, because like this one here, like you're only going back a year. So let's look real quick. And I pulled up another chart here to show, let's go back and say, okay, where was unemployment in 2019? It was 5.66. Where was it in 2018? 5.83. Where was it in 2017? 6.34. And then from 2016, 2015, 2013, 2014, it hovered at 7% essentially for all of those years. So really, it was in that 7% range. It then made its way down to 5.6%. Then it really skyrocketed because COVID happened. But the point is 5.8% is still relatively low as it relates to the overall kind of where we've been in the last, and I just gave you kind of a 10-year snapshot there. And that's important for people to understand.
So I want to shine a light on something here, JG. When you look at this chart, you go to the far left-hand side of this chart, it's 5%. All of a sudden it spikes to 5.8%. Here's what we see in the headlines, which is this whole negative tone. Unemployment is starting to spike. It's starting to rise. People aren't working. You have an opening where you're talking about availability of labor. 5%, I've said this many, many, many times. I can't stress it enough. 5% is not a healthy unemployment rate. It's what drives to, what we talked about. It's what drives inflation. It's hard to grow a business when you can't get labor. And so when we get into this 5.8 right up to 7%, which is what you just shared, those are healthy unemployment numbers. There's a nice churn within the labor market. There isn't a bunch of upward pressure on salaries and wages, which helps control costs. So the point of that little part that I'm pointing or shining a light on, JG, is just to say this, is we're going to see 6.5%, maybe 7% unemployment. Yes, Ontario will crest 6%. It doesn't mean the world's coming to an end and the economy's failing. It doesn't mean any of that. As a matter of fact, that is, I think, part of a healthy economic reset, which is what we're going through, where we're starting to see the labor market open up, more availability of labor, and managing our costs. So that's what I got to say about that. The headlines, however, will be a doom and gloom headline, smattering of, all sorts of papers, media saying the world's coming to an end.
Of course. Now, here's the good news, Patrick. You made this Patrick prediction of Ontario cresting 6%. I love it. I also love when you're right, because based on this chart here, it looks like we've already crested 6%, 6.3% to be precise. So you're right. Again, just your timing was off. It happened last month, not next month. But and here's the, I joke, but here's the unemployment rate across the country, province by province, but also for investors to keep you guys anchored to. The unemployment rate is tracked at a regional level. So you got to see what's going on. Just because Ontario is at 6.3%, doesn't mean that Kitchener-Waterloo's at 6.3%. Kitchener-Waterloo might be at 4%. Peterborough might be at 12%. The average of Ontario is at 6.3%, but Ontario is massive, and so is every province that we have. Ontario is the biggest one, but as a result, the point is you got to go regional. I digress, but I remain.
Yeah, well, no, and I think that's such an important point that you make. When you look at KWC, when you look at Barrie or London, we start Windsor. We know that unemployment is bumping 7% in some of those regions. So it's not to say, though, that that's doom and gloom. There's still demand. There's still people in the workforce. As an investor, what are we concerned with? Well, we're concerned with, are there renters? Are there people that can afford rent and, afford to pay our rent? So the answer is still yes, even when unemployment's at 7%. You got to be more diligent in how you do your credit checks or how you do your tenant checks, but ultimately there's still demand, and that's what we're looking for as investors.
Unemployment rate covered. Nice shot, straight into the camera. Beautiful.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.